Dear investor, in this edition, let us discuss 1. Union budget, 2. Quarter 3 result seasons, 3. Valuations, key themes that we are focused on, and capex theme in particular. And lastly, our belief that it continues to be time for alpha. On the first topic, Union budget, past period saw budget being tabled, budget continued to focus on capex-led growth and scored on consolidation focus even in a pre-election year. Taxation was left largely unchanged, which was welcome. In capex, railways scored highest growth, defense saw a 8.5% increase. Those are the two spaces that market was focused on. Tax arbitrage between bonds and MLDs was removed. Overall, the budget maths was credible. Removal of tax benefit for debt has made equity assets relatively more competitive versus debt for investors. This is something we will touch on again. Coming down to quarter 3 result season takeaways. Quarter 3 has ended, Nifty profit saw a 12% increase on a YOY basis. However, this is a season when consumption slowdown was seen across the board in FMCG, in consumer durables, discretionary, two-wheelers and retail. The pack has seen earnings downgrades as well. Secondly, commodities, metals, oil and gas, cement dragged the quarter down with 63%, 19% and 28% earnings decline respectively. Banking and financial though was the most consistent performer with a solid 40% growth on a relatively high base. Auto surprised and did much better than expected. So that was the high point of the quarter. Excluding metals and oil and gas, Nifty and the universe delivered a solid 29% and 31% earnings growth respectively. Overall, after the result season, Nifty EPS has seen a small 1% cut in earnings, maybe mainly on account of downgrades in metals. Financial 23 earnings growth is now expected to be 11.6%. For 24, Nifty earnings remain largely unchanged at over 990 on the Nifty. Higher interest costs seem to be impacting the discretionary spends. Interest rates have increased. People who have bought houses, cars, etc. on loan have seen that cost go down. This trend should improve as the economy provides more jobs to the deprived sections and another round of wage increases are effected, as the new fiscal starts. On valuations, we have maintained that market should trade between 18 and 18.5 times 1 year forward earnings, with 1 year forward earnings still being maintained close to 1,000. It implies a fair market level of between 18 and 18.5 thousand on the Nifty. Debt on a pre-tax basis continues to look more attractive, relatively speaking, versus equities. However, versus the last period, the relative attractiveness has reduced somewhat with a rally in bonds post-budget and a small fall in equities. More importantly, the post-tax attractiveness of debt has reduced considerably for Indian investors on account of changed taxation rules on the MLDs. This should result in better allocation from HNIs into equity in the new fiscal year. Key themes that we are focused on. We had shared the themes in the last edition also. The focus spaces like defense on indigenization focus, hospitals in the healthcare space, banks on continued lending growth and benign credit cycle, engineering and cap goods on manufacturing renaissance, chemicals on China plus one continues to be the focus. We believe that autos have taken care of technology related worries and platform changes, and now present a relatively more attractive opportunity versus other consumption spaces. In some part, this is a takeaway from Q3 numbers as well. Focus on the capex cycle. As compared to the past, when consumption was the sole driver of growth, capex is increasingly the new growth driver. Data set around order inflows, short cycle revenues of machinery and consumables, and capital goods imports together paint a picture that investment cycle build is strengthening. Investment cycle seems to have skirted the pitfalls of macro headwinds and commodity price volatility resulting from the Russia-Ukraine war. Multiple drivers of capex cycle may make it larger and sustainable versus the narrow focus last time. We see several sectoral drivers of an investment cycle, and this breadth can make it larger and more sustainable despite skepticism. This is contrary to the narrow power sector driven cycle last time. Sectoral leadership can be driven by one, manufacturing, including defense, and this is a place where government has provided substantial push. Two, public spend on key sectors, rail, road, water, and urban infrastructure. And three, energy transition, from renewable storage of energy, electric vehicles, and hydrogen, including real estate, metallurgy, logistics, and data centers, amongst others. So this is a period where a lot of spaces could provide the capex momentum. Capacity utilization levels though are hovering at sub 75% levels, and the whole thought is that they need to inch up for a stronger capex cycle to evolve. However, lot of the capacity in India may be old and needs replacement, and replacement stroke retrofitting and technological upgradation led capex could benefit companies that provide cutting edge solutions. In Q3, capital good companies have reported strong margin expansion. This is usually a good lead indicator of strong demand outlook, better capacity utilizations, or new capabilities that are not yet commoditized. Lastly, we continue to believe that it is time for alpha. As we go forward, manufacturing margins should see an expansion, and the compression in earnings spread that was seen in Q3 should reverse. Broader earnings growth should help market breadth. Moreover, new spaces like defense and chemicals, which are long period compounding stories, have emerged and provide alpha opportunities. And of course, this is helped by alpha seeking domestic money flow. So I think times for managers should turn more favorable as we go forward. On that count, thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.